For years, $1 million Bitcoin was a meme, a sailor tweet, a bull market fantasy that got laughed out of every serious finance room on Wall Street. Well, that is over. Because in the last 18 months, the biggest asset managers on Earth, BlackRock, Fidelity, ARK, Bernstein, VanEck, have quietly published the same conclusion. Bitcoin is going to seven figures, and it's not just as a moonshot. This is a base case. And the models they're using to get there aren't built on hopium. They're built on supply shock math, ETF absorption rates, and sovereign accumulation scenarios that already are starting to play out in Washington. Now, I know what some of you are thinking. Bitcoin is sitting at $81,000 right now. It's down 35% from the October 2025 all-time high of $126,000. It's down 21% on the year. So, why are we even talking about $1 million price target when the chart looks like this? Well, because the institutions calling for seven figures are looking at this exact drawdown and concluding that the thesis got stronger, not weaker. And in the next 15 minutes, I'm going to show you exactly why. We're breaking down which institutions are calling for $1 million Bitcoin, the math behind their models, what's structurally different about this cycle, the sovereign wildcard nobody is pricing in, the realistic time frame, and the risks that could break the entire thesis. So let's get into it. Let's start with the institutional shift, because this is the part most people are still missing. 2 years ago, the idea that BlackRock would build a Bitcoin product was treated as a crypto Twitter delusion. Today, BlackRock iShares Bitcoin Trust holds roughly 800,000 Bitcoin. That's almost 4% of the total supply that will ever exist. It became the fastest ETF in history to reach $50 billion in assets under management. Larry Fink, the man who once called Bitcoin an index of money laundering, now describes it as, quote, an asset of fear, a hedge against currency debasement and fiscal deficits. In January 2025, Fink floated a conditional price target of $700,000 per Bitcoin if sovereign wealth funds allocate just 2 to 5% of their portfolios into it. That's not a meme account on Twitter. That's the CEO of the largest asset manager on planet Earth. Then there's ARK Invest. Cathie Wood's team published their 2025 Big Ideas report with 3 Bitcoin scenarios for 2030. Bear case, 300,000. Base case, 710,000. Bull case, $1.5 million per coin. Bernstein, one of the most respected research houses on Wall Street, has a published roadmap calling for 150,000 by end of 2026, 200,000 at the cycle peak in 2027, and $1 million Bitcoin by 2033. Their lead analyst has a phrase for what's happening right now. He calls it, quote, Wall Street replaces Satoshi. VanEck dropped a paper on January 8, 2026, written by Matthew Siegel and Patrick Bush, modeling Bitcoin out to 2050. Their base case price target is $2.9 million. Their bull case, in a hyper-Bitcoinization scenario, hits $53 million per coin. And in May of this year, Siegel said publicly that $1 million Bitcoin within 5 years is now VanEck's base case. Fidelity's Jurian Timmer has been modeling a path to $1 million by 2030 using Metcalfe's law and the internet adoption curve. Standard Charter's Geoff Kendrick has a published target of $500,000 by 2030. Now, here's what I want you to notice. These are not the same firms that pumped Dogecoin in 2021. These are the firms that manage retirement accounts for teachers and firefighters. And they all looked at the same data and came to versions of the same conclusion. So, how do you get from 81,000 to over $1 million? Well, let me walk you through the math. Start with supply. After the April 2024 halving, Bitcoin's daily issuance dropped roughly 450 new coins per day. That's about 164,000 new Bitcoin per year. Total inflation rate? Less than 1% annually. Now, look at demand. Combined assets under management across the 5 major US spot Bitcoin ETFs is approximately $97 billion as of right now. In April 2026 alone, those ETFs absorbed about 19,000 Bitcoin. That's about 9 times the entire monthly miner output. In a single 9-day inflow streak, ETFs ate weeks of new supply. Bitwise estimates that ETFs alone could absorb more than 100% of all newly mined Bitcoin in 2026. And that's just ETFs. That doesn't include corporate treasuries. That doesn't include sovereigns. That doesn't include direct retail purchases. Now, let me give you the cleanest back-of-the-envelope calculation in this entire video. Gold has a market cap of approximately $20 trillion. Bitcoin's circulating supply is about 19.8 million coins. If Bitcoin reaches gold parity, and that's the entire institutional thesis right there, Bitcoin as digital gold, you do the division. 20 trillion divided by 19.8 million. That gives you a price of approximately $1,010,000 per Bitcoin. That's it. That's the entire math. That's why every serious institutional model converges on a 7-figure price. Because if Bitcoin is digital gold, 1 million is not the ceiling, it's the equilibrium. Now layer in the sovereign component. Global sovereign reserves total roughly $12 trillion. If just 1% rotates into Bitcoin, that's $120 billion of new demand. At the current market cap, that's a 7.5% capital injection from a single demand category. ARK estimates that a 2.5% allocation across $200 trillion of global investable assets could add $5 trillion to Bitcoin's market cap by itself. That alone gets you to roughly $250,000 per coin. Stack the buckets. Gold parity gets you to $1 million. Sovereign rotation accelerates it. ETF absorption tightens the float. Corporate treasury accumulation removes float entirely. The math doesn't require a miracle. It requires the trends already in motion to continue for another 5 to 7 years. But here's the question I want you to actually sit with. Why is this cycle structurally different from every previous cycle? Because if it's not different, if this is just 2017 and 2021 with new branding, then everything I just told you is wrong. Here's why it is different.
Right, folks, a quick interlude because I think you're going to want to know this as well. Now, a lot of people still think Coinbase is just a beginner platform, but with Coinbase Advanced, that's actually changed quite a bit. You're getting lower fees, proper charting tools, real-time order books, and full control with limit and stop orders. So it all feels much closer to a professional trading setup, but without the usual complexity. So whether you're stepping up from basic apps or just want a cleaner, more reliable platform, it is definitely one to have on your radar. And if you want to try it out, there's currently a limited offer for Coin Bureau viewers. You can get $40 in Bitcoin when you trade $40. Now, this is available in the US, Canada, Europe, Singapore, and Australia, but it's capped to the first 350 people, so it may not last long. You can scan the QR code on screen now or check the link in the description and pinned comment for full details. And with that, let's get back to it.
Spot Bitcoin ETFs launched in January 2024. For the first time in history, a pension fund manager in Ohio can allocate to Bitcoin through the same vehicle that they use to buy the S&P 500. By Q1 2026, institutional investors accounted for over 60% of all spot Bitcoin ETF inflows. That is not the retail-driven leverage casino of 2021. This is fiduciary capital with mandates. And that capital behaves completely differently. When Bitcoin dropped 50% from $126,000 to $60,000 between October 2025 and February 2026, you would have expected a stampede. Instead, ETF outflows over that entire period totaled $6.4 billion, less than 7% of total assets under management. Then the bleeding stopped. April 2026 saw $2.4 billion of net inflows, 6 consecutive weeks of net positive flows through May. BlackRock's IBIT alone took in $8 billion during the worst of the drawdown. Larry Fink called it accumulation on the dip. Then there's corporate treasury. Strategy, formerly MicroStrategy, holds over 500,000 Bitcoin on its balance sheet. But it's not just Saylor anymore. Approximately 172 publicly traded companies now hold more than 1 million Bitcoin combined. That's over 5% of the entire circulating supply locked on corporate balance sheets. Metaplanet in Japan is targeting 100,000 Bitcoin by the end of this year. 21 Capital, backed by Cantor Fitzgerald, holds over 40,000 coins. The Sailor playbook has been exported globally. Then there's the regulatory unlock. The Genius Act was signed into law on July 18, 2025. It's the first comprehensive federal framework for stablecoin issuers. It established one-to-one reserve requirements, AML compliance, and bankruptcy protections for stablecoin holders. The Clarity Act, which classifies Bitcoin explicitly as a digital commodity under CFTC jurisdiction, is moving through the Senate Banking Committee right now. The White House is targeting a presidential signature by July 4th. Polymarket has the odds of Clarity Act passage in 2026 around 73%. Combine all of that, ETF corporate treasuries, regulatory clarity, and you have the infrastructure that previous Bitcoin cycles never had. Every previous cycle was retail-led. This one is institution-led. That's the difference. But there's one variable that could compress this entire timeline by years, and nobody is properly pricing it in. And that's sovereign accumulation. On March 6, 2025, President Trump signed an executive order establishing the Strategic Bitcoin Reserve. The reserve declared that Bitcoin deposited into it shall not be sold. It explicitly prohibited the fire sale auctions of seized Bitcoin that the US government had been doing for a decade. The current holdings, sourced from criminal forfeiture, sit at roughly 200,000 Bitcoin. That makes the United States the largest known sovereign holder on the planet. But the executive order is just the first step. Senator Cynthia Lummis has reintroduced the Bitcoin Act, now being rebranded as the American Reserves Modernization Act. The bill authorizes the Treasury to purchase 200,000 Bitcoin per year for 5 years, a total of 1 million Bitcoin, nearly 5% of the total supply. White House advisor Patrick Witt confirmed in May that the administration is preparing what he called a major announcement on operationalizing the reserve, with potential Treasury purchases beginning in Q4 2026. Now, think about the game theory. If the United States openly accumulates 1 million Bitcoin, what does that signal to every other G20 finance minister? Czech National Bank's governor has already said publicly that a 1% Bitcoin allocation can enhance portfolio risk-adjusted returns. Japan's cabinet approved amendments in April that formally classified cryptocurrencies as financial products. A Nomura survey found that 80% of Japanese investment professionals plan to allocate up to 5% of portfolios to digital assets by 2029. El Salvador continues its 1 Bitcoin per day strategy despite IMF pressure. This is the asymmetric catalyst. Once one major nation publicly commits to accumulation, the rest face a choice. Move now while it's still cheap, or buy later from countries that already own it. That's nation-state FOMO. And it's the single variable that could compress a 10-year timeline into 3 years. Now, before I go any further, I do owe you something. Honestly, it's about the time frame. Because the people on YouTube screaming about 1 million Bitcoin by next Tuesday are not the institutions. The institutions are saying something very different. ARK's bull case of 1.5 million is targeted for 2030. Bernstein's $1 million target is 2033. VanEck's near-term base case is roughly 2031. Standard Chartered actually pushed their $500,000 target back from 2028 to 2030, citing weaker corporate demand and slower than expected ETF inflows. Even Fidelity's Jurrien Timmer, who has the bullish million by 2030 model, has been openly cautious about 2026. He thinks October 2025 peak at 126,000 may have been the cycle top. He's calling 2026 a dormant year, with support somewhere between $65,000 and $75,000. That's a credible institutional voice saying the bullish thesis is intact, but the next 12 months might be flat or even worse. Now, I'm not going to pretend that doesn't matter. The institutional consensus arrival window for 7-figure Bitcoin is roughly 2028 through 2033. That's 2 more halving cycles. Anyone telling you it's happening in the next 6 months is pretty much selling you something. So now let's talk about what could break this entire thesis, because I'm not interested in just cheerleading. I'm interested in being right. Risk number 1, macro liquidity reversal. The 10-year Treasury is sitting at 4.38%. The Fed funds rate is at 3.64%. If yields spike towards 5% and stay there, Bitcoin's opportunity cost gets ugly fast. A hawkish Fed pivot, particularly under a new chair like Kevin Warsh, could drain crypto liquidity overnight. Sustained dollar strength historically correlates with Bitcoin underperformance. Risk number 2, sustained ETF outflows. The $6.4 billion outflow stretch from November 2025 to February 2026 was the first real stress test. The thesis survived because institutional holders sat still. But if outflows resume and exceed 10% of total assets under management over a 30-day window, the institutional floor narrative breaks. So you should watch for it. Risk number 3 is the regulatory black swan. If the Clarity Act fails to pass before the November midterms, Senator Loomis has openly warned that comprehensive crypto regulation could be delayed until 2030. That's a 5-year setback for institutional integration. The strategic Bitcoin reserve currently exists by executive order only. A future administration could reverse it with a signature. Risk number 4, the quantum question. Google research published in March 2026 suggested the computing power needed to break Bitcoin's encryption may be 20 times lower than previously estimated. This is not an immediate problem. Most cryptographers put cryptographically relevant quantum computers somewhere in the 2030s. But Bitcoin's defense, the BIP 360 post-quantum upgrade, is still in development. If consensus on that upgrade isn't reached before quantum hardware matures, you have a real existential question. Now, risk number 5 is credible competition. ARK already trimmed its bull case by $300,000 because stablecoins are eating Bitcoin's emerging market payments use case. The stablecoin market just crossed $320 billion. Bitcoin's monopoly on monetary innovation is no longer absolute. These risks are real. You should hold them in mind alongside the bull case. That's how you avoid getting wrecked. So, given all of that, what should you be actually tracking? Well, here are the signals that tell you whether the thesis is still on the rails or coming off of them. First, ETF flow data. Farsight Investors publishes daily flow tables for free. 7 consecutive days of net outflows is a warning. 30 days is a serious problem. A breach of 10% of total assets under management is a thesis breaker. Second, the MRVR ratio. This measures market value against the average price holders paid. The 2025 cycle peak hit MVRV of about 2.5. That's well below the 4+ levels that marked the 2017 and 2021 tops. Right now, we're sitting in the 1.4 to 2.3 range, mid-cycle territory. Not overheated, not capitulated. Third, exchange reserves. Bitcoin held on exchanges just hit a 7-year low at 2.21 million coins, down from 3.4 million in 2022. If that number keeps on dropping, the supply squeeze is real. If it reverses sharply, holders are preparing to sell. Fourth is the legislative tracker on congress.gov. Watch the Clarity Act vote. Watch the Bitcoin Act progress. These are binary catalysts. Fifth is the 13F filings on SEC EDGAR, quarterly disclosures from institutional managers. Watch for new sovereign wealth funds and pension funds appearing as filers for IBIT and FBTC. Sixth is the Strategic Reserve announcement. The White House has indicated a major operational announcement is coming in the next few weeks. That's the catalyst that could trigger nation-state FOMO. If you monitor those 6 signals consistently, you'll know exactly where the thesis stands at any given moment. $1 million Bitcoin used to be the punchline. Now it's the price target on the desks of the most sophisticated capital allocators in the world. That doesn't guarantee that happens, and the drawdown is real. The risks are real. The timeline is longer than the Moon Boys want to admit. But what is also real is this. The supply is fixed. The infrastructure is built. The legislation is moving. And the institutions that spent a decade dismissing this asset have quietly run the math, looked at the demand, and concluded that the asymmetric bet is now pretty obvious. The question isn't whether $1 million Bitcoin is possible. The question is whether you're positioned for it before everyone else figures out the institutions already are. The next few years are going to separate the people who understood what was happening from the people who watched it happen. Don't be in the second group. If you got value from this, then smash the like, hit subscribe, and I'll see you in the next one. Thanks for watching. This is Lewis, signing off.